Success in trading is rarely an accident. It is the product of a deliberate, consistent approach to understanding markets, mastering psychology, and executing a plan that aligns both with the trader's capabilities and the realities of the market. The journey toward achieving substantial trading success in 5 years is not about chasing profits quickly or seeking shortcuts. Instead, it is about cultivating the mindset, discipline, and skills that allow a trader to navigate uncertainty, risk, and the inevitable losses that come with every market. At the foundation of this 5-year plan lies the recognition that trading is a process, not an event. Each trade, whether profitable or not, provides feedback. The trader who views this feedback objectively rather than emotionally is the one who can adapt, learn, and improve. Understanding that losses are an integral part of the system, not a personal failure, is critical to building resilience. This perspective shifts the focus from fear and greed to consistent execution and strategic learning, which forms the cornerstone of long-term success. A comprehensive 5-year plan is built around structured stages. The first stage emphasizes education and preparation. During this period, the trader develops a thorough understanding of market mechanics, different instruments, and risk management principles. This stage is not about immediate profitability, but about creating a foundation that will support sustainable performance. The second stage transitions into applying strategies in a controlled environment, often using simulated trading to refine decision-making skills without the pressure of financial loss. The third stage involves small-scale live trading, where real-world conditions test the trader's discipline, emotional control, and ability to stick to the plan. Here, the key is to remain consistent, maintaining risk controls and avoiding impulsive decisions. Performance is measured not only by profits, but by the trader's adherence to process and ability to learn from each outcome. As the 4th and 5th years approach, the plan focuses on scaling up and refining strategies. The trader begins to integrate insights gained from experience, adjust techniques to changing market conditions, and enhances the mental frameworks necessary for sustained success. Confidence is built not on ego or over-optimism, but on repeated evidence of disciplined execution and thoughtful analysis. Ultimately, a 5-year plan to trading success is not about following a rigid formula, but about creating a system that aligns behavior, mindset, and skills with the unpredictable nature of markets. Patience, self-awareness, and commitment to continuous improvement transform a novice into a trader capable of consistent results. The path is challenging, but with a deliberate plan that considers the psychological and practical demands of trading, success becomes not a matter of chance, but of consistent effort applied over time. Trading success is not something that happens overnight. It is not the result of luck or a sudden insight that magically produces consistent profits. Rather, it is the product of a deliberate, thoughtful process that combines knowledge, skill, and above all, discipline. Every trader who reaches a level of sustained success understands that the markets are complex, unpredictable, and often counterintuitive. They know that, without a structured approach, it is all too easy to become overwhelmed by emotion, to overreact to losses, and to deviate from a plan that could otherwise guide them steadily forward. The foundation of trading success lies not in the charts or the indicators themselves, but in the mindset that governs how a trader approaches each opportunity, each risk, and each outcome. It begins with understanding that trading is fundamentally a behavioral endeavor. A trade is executed by a human being who interprets the market through a filter of experiences, fears, hopes, and expectations. If these filters are left unchecked, they can distort perception and lead to inconsistent decision-making. The disciplined trader recognizes this and works to cultivate a mental framework that allows objective evaluation of situations. This framework does not eliminate emotion. Emotions are natural and inevitable, but it channels emotion in ways that serve rather than sabotage performance. Discipline in trading manifests as the consistent application of a system or method that has been developed and tested over time. It means defining rules for entry, exit, and risk management, and then adhering to them regardless of whether the market appears to offer tempting deviations. Many traders fall into the trap of believing that intuition or a hunch can replace process. While intuition can occasionally lead to profitable trades, relying on it as a primary guide is dangerous because it is subject to bias, fear, and greed. The disciplined trader recognizes that the path to success is paved with repetition and consistency, not with occasional flashes of brilliance. Every trade executed according to the system provides information, Every deviation from the system produces lessons that are often costly but no less instructive. Discipline ensures that these lessons are captured and integrated into the trader's development rather than ignored or rationalized away. An essential aspect of discipline is patience. Markets do not conform to schedules or desires. Opportunities arise and vanish without warning, and the trader who attempts to force trades or overtrade in search of quick results will almost inevitably experience frustration and losses. Patience is the ability to wait for conditions that meet the predefined criteria of a system and to resist the impulse to act prematurely. It is also the recognition that results in trading should be measured over a series of trades rather than a single outcome. A disciplined approach values process over short-term profit and focuses on consistency rather than occasional extraordinary wins. The mindset of a successful trader embraces this principle wholeheartedly. Another dimension of discipline involves risk management. Even the most profitable strategy can lead to ruin if risk is not carefully controlled. Successful traders understand that every trade carries the possibility of loss, and that controlling the size and impact of those losses is more important than chasing the next big gain. Discipline ensures that position sizes are appropriate, stop-loss orders are respected, and capital is preserved for future opportunities. Without this aspect of self-control, even a well-developed method can fail because emotional reactions to losses often lead to impulsive decisions that compound mistakes. Discipline also extends to self-analysis and reflection. A trader who seeks consistent success spends time reviewing trades, understanding what worked, what did not, and why. This process requires honesty, humility, and the willingness to confront mistakes without defensiveness. It is through this disciplined examination that insights emerge and methods are refined. It is not enough to simply execute trades mechanically. One must also understand the underlying causes of outcomes in order to adapt and improve continuously. Importantly, trading success depends on the integration of discipline with psychological resilience. The ability to remain calm in the face of losses, to resist the allure of revenge trading, and to maintain clarity under pressure is what separates successful traders from those who fail. Markets are inherently uncertain and outcomes can never be guaranteed. The disciplined trader accepts this reality, making decisions based on probabilities and the systematic application of strategy rather than on hope or fear. This mindset allows for objective evaluation, learning from mistakes, and gradual improvement. In practical terms, discipline manifests as the ability to follow routines, to respect the signals provided by one's system, and to maintain focus even when conditions are stressful. It means setting realistic expectations and avoiding overconfidence, which can be as destructive as fear. A trader who maintains discipline develops habits that reinforce positive behavior and reduce the influence of impulse or emotion. These habits become the foundation upon which long-term success is built. Discipline is not static. It must be developed, strengthened, and maintained over time. Every decision, every trade, every interaction with the market is an opportunity to practice and reinforce disciplined behavior. It requires conscious effort, self-awareness, and the willingness to confront personal weaknesses. A trader may have the best technical knowledge, the most sophisticated indicators, and a robust system, but without discipline, these tools are insufficient. The ability to consistently apply knowledge in alignment with one's plan, to resist the temptation to deviate under pressure, and to maintain emotional balance defines the trader who succeeds over the long term. Ultimately, the disciplined approach to trading is not merely a set of rules. It is a mindset that governs how the trader interacts with the market and with oneself. It is the understanding that success is earned through consistency, self-control, and deliberate action rather than through chance or emotion. The disciplined trader recognizes that the markets are neutral, that outcomes are probabilistic, and that it is the consistent application of process that produces results. This understanding shapes behavior, informs decisions, and sustains performance, creating the conditions under which trading success becomes achievable. Losses in trading are inevitable, yet how a trader perceives and responds to them is the defining factor between long-term success and repeated failure. Every market participant experiences losses, and the markets do not discriminate between the novice and the experienced. What separates successful traders from others is the understanding that losses are not personal failures, moral shortcomings, or indications of incompetence, but rather feedback. information that reveals the strengths and weaknesses of one's approach, mindset, and execution. Accepting this reality is critical because it changes the relationship a trader has with the market. When losses are seen as a natural and informative part of the process, fear diminishes and learning begins. The first step in viewing losses objectively is recognizing that the market operates on probabilities, not certainties. No trader, no matter how skilled, can predict the market with complete accuracy. Every trade carries inherent risk, and even the most meticulously planned trade can result in a loss. Successful traders internalize this fact and understand that outcomes are often independent of effort or skill in the moment of execution. This awareness allows them to detach emotionally from individual trades, focusing instead on the quality of their decision-making process. A well-executed trade can lose, and a poorly executed trade can win. Over time, however, consistent application of a disciplined strategy produces favorable results. Viewing losses as feedback requires a shift in mindset from reactive to analytical. Instead of responding emotionally to a loss with frustration, anger, or self-criticism, a trader examines what led to the outcome. Was the trade entered according to plan? Were risk management rules followed? Did external factors or emotional impulses influence the decision? Each loss, approached in this manner, becomes a valuable lesson that can be applied to future trades. This process of reflection is not passive, it is an active engagement with the market and oneself, demanding honesty, humility, and curiosity. Emotional resilience plays a central role in handling losses effectively. Fear and regret are natural responses, but they become destructive when they influence future trading decisions. Traders who allow losses to dominate their emotions often fall into patterns such as revenge trading, overtrading, or abandoning their strategy altogether. Recognizing that emotions are temporary and manageable is key. Techniques such as journaling trades, reviewing performance objectively, and maintaining a focus on process rather than outcome help to prevent emotional escalation. In this sense, psychological training is as critical as technical skill in developing the capacity to treat losses as constructive feedback. Another aspect of understanding losses is the acknowledgement that they are an essential part of probability-based trading. Success in markets is measured over a series of trades, not individual outcomes. This perspective allows traders to evaluate performance based on adherence to rules, execution quality, and risk management, rather than the occasional win or loss. Losses provide information about the system's performance under different conditions, the trader's emotional state, and the effectiveness of decision-making frameworks. A trader who learns to extract insights from losses gains a significant advantage, because each setback contributes to growth and refinement. The concept of feedback extends beyond the mechanics of trading to include psychological and behavioral patterns. A trader may notice that losses often occur after periods of overconfidence, fatigue, or impatience. Recognizing these correlations allows the trader to implement strategies to mitigate similar outcomes in the future. Feedback from losses also illuminates tendencies such as hesitation, impulsivity, or deviation from a plan. By treating each loss as a data point, the trader develops an evolving understanding of personal strengths and weaknesses, leading to greater self-awareness and improved decision-making. Importantly, viewing losses as feedback requires discipline and structure. Without rules and systems in place, a trader is vulnerable to emotional distortions, rationalizations, and bias. Losses can trigger self-doubt or overreaction, which may lead to inconsistent behavior. The disciplined trader, however, approaches losses systematically, analyzing results, documenting patterns, adjusting rules as necessary, and maintaining alignment with the overarching strategy. This approach transforms losses from obstacles into instruments of learning, fostering a mindset oriented toward long-term improvement rather than short-term vindication. An essential element of this mindset is detachment from personal identity. Many traders tie their self-worth to outcomes, interpreting losses as reflections of their competence or intelligence. This perspective is detrimental because it generates fear, frustration, and defensive behavior. Successful traders separate their sense of self from the market results, recognizing that losses are inherent to the probabilistic nature of trading. By removing the personal ego from the equation, they can evaluate performance objectively, identify mistakes, and adjust strategies without emotional interference. In practice, treating losses as feedback involves developing routines and habits that reinforce objectivity. This includes maintaining a trade journal, performing regular performance reviews, conducting post-trade analysis, and implementing risk controls that limit emotional exposure. These habits create a framework in which losses are expected and normalized, reducing their emotional impact and enhancing the trader's ability to learn from them. The process also fosters confidence, not in predicting outcomes, but in the trader's ability to execute a plan consistently and adapt based on information gained from experience. Finally, losses offer insight into the interplay between market behavior and personal psychology. They highlight areas where a trader's perceptions, biases, or emotional responses may interfere with rational decision-making. Each loss is an opportunity to confront these influences, to recalibrate mental approaches, and to reinforce the discipline necessary for long-term success. By embracing losses as a source of feedback rather than as failures, a trader develops resilience, clarity, and a deeper understanding of both the markets and oneself. This perspective transforms the trading experience into a continuous learning journey where every setback contributes to eventual mastery, where emotional composure and objective analysis become the currency of progress, and where feedback from losses becomes the most valuable tool for growth. Structured stages in trading, education, practice, small-scale trading, refinement, form the backbone of a trader's development, transforming raw ambition into disciplined, consistent performance. Trading is a skill that cannot be learned overnight, and the pathway to success is best approached as a series of progressive stages, each with distinct objectives, challenges, and learning opportunities. The process begins with education, a stage that lays the foundation for every subsequent step. At this stage, the trader immerses themselves in the mechanics of the markets, the behavior of different instruments, and the principles that govern price movement. Knowledge of fundamental and technical factors, market structure, volatility, and the interrelationships between various asset classes equips the trader with the tools to make informed decisions. This is not simply about memorizing indicators or strategies, but about developing a deep comprehension of how markets operate, how participants interact, and how probabilities unfold over time. Education also includes understanding the psychological aspects of trading, including the tendencies toward fear, greed, and overconfidence that can sabotage even the most well-conceived strategies. The next stage involves practice, often in simulated environments or paper trading scenarios. This stage bridges the gap between theoretical knowledge and real-world application. Practice allows the trader to test strategies, observe patterns, and refine decision-making without the pressure of risking actual capital. It is during this period that habits begin to form, including the discipline to follow rules, the patience to wait for setups, and the consistency to adhere to risk management principles. While simulated trading cannot fully replicate the emotional intensity of real trading, it provides a safe environment for learning from mistakes, experimenting with different approaches, and understanding the nuances of timing and execution. Success at this stage is not measured by profitability, but by the trader's ability to consistently apply process and learn from outcomes. After gaining confidence in practice, the trader enters small-scale live trading. This stage introduces real consequences, where capital is at risk and the psychological pressures of potential loss come into play. Small-scale trading allows the trader to experience emotions such as fear, anxiety, and impatience in a controlled manner, helping to build resilience and emotional stability. The objective is not to maximize profit, but to develop the capacity to make rational, disciplined decisions under pressure. Maintaining strict adherence to risk management, trade rules, and position sizing is critical during this phase. Each trade provides immediate feedback on the trader's ability to implement strategies effectively while managing emotions. The focus remains on learning and adaptation, gradually building a track record of controlled execution rather than large gains. As experience accumulates, the trader moves into a stage of refinement. This phase involves analyzing performance, identifying strengths and weaknesses, and adjusting strategies to improve effectiveness. Refinement is both a technical and psychological process. Technically, the trader examines which strategies produce consistent results under varying market conditions, fine-tuning entries, exits, and risk parameters. Psychologically, the trader develops greater self-awareness, recognizing patterns of behavior that lead to errors such as impulsive decisions, overtrading, or hesitation. Feedback mechanisms, including journals, performance reviews, and structured reflection, are essential to this stage. Refinement is iterative. Strategies are tested, results are measured, and adjustments are made continuously to align performance with long-term objectives. Throughout these stages, discipline and patience are fundamental. Education, practice, small-scale trading, and refinement are not isolated steps but interconnected processes that build upon one another. Skipping stages or attempting to accelerate progression often leads to mistakes, overconfidence, and emotional breakdowns. A disciplined approach ensures that each stage is fully internalized before moving to the next, creating a foundation of skill, knowledge, and psychological resilience. The progression through structured stages also reinforces the importance of process over outcome. Success is not determined by the profits of a single trade, but by the consistent application of method, adherence to risk management, and the ability to learn and adapt over time. Structured stages also provide clarity and measurable objectives. During education, the goal is mastery of concepts and principles. During practice, it is consistent application of strategies. During small-scale trading, it is emotional resilience and adherence to rules. And during refinement, it is optimization and continuous improvement. These stages act as benchmarks, allowing the trader to evaluate progress, maintain focus, and remain motivated during periods of challenge or setback. Each stage offers distinct opportunities for learning, building competence, and reinforcing positive habits that become second nature over time. In addition, structured stages encourage a probabilistic mindset. By progressing gradually, the trader learns to view markets as a series of probabilistic events rather than certainties. Each stage reinforces the understanding that outcomes are not guaranteed and that the key to long-term success is managing risk, analyzing feedback, and improving process rather than attempting to predict individual results. This mindset reduces emotional reactivity and fosters a calm, analytical approach that is essential for sustainable performance. The structured approach also supports the development of self-awareness, which is critical for navigating the psychological challenges of trading. By moving through defined stages, the trader has the opportunity to recognize behavioral patterns, emotional triggers, and cognitive biases. Education provides the intellectual framework for understanding markets. Practice allows for observation of behavior without risk. Small-scale trading exposes emotional tendencies under real conditions, and refinement enables conscious adjustments to thought processes and behaviors. This progressive self-awareness strengthens discipline, enhances decision-making, and fosters confidence grounded in consistent, repeatable process rather than fluctuating results. Finally, the concept of structured stages emphasizes the importance of time in the development of trading skill. Mastery does not occur instantaneously. It is the result of deliberate practice, thoughtful reflection, and gradual accumulation of experience. By approaching trading as a staged process, the trader aligns expectations with reality, reduces the likelihood of premature frustration, and increases the probability of long-term success. Each stage builds on the previous, creating a cumulative effect that strengthens technical ability, psychological resilience, and overall performance. Emotional control and adherence to the plan are the pillars of consistent trading success, yet they are among the most difficult challenges for any trader to master. Markets are inherently unpredictable, and human nature is wired to react instinctively to uncertainty, risk, and potential reward. Fear and greed, hope and regret, impatience and overconfidence, these emotional responses can hijack rational decision-making if left unchecked. Understanding the critical importance of controlling these impulses is central to achieving reliable performance. Emotional control does not imply the absence of feeling. Rather, it involves recognizing emotional reactions, understanding their source, and preventing them from dictating actions that deviate from a carefully constructed trading plan. Adherence to the plan begins with the development of a well-defined strategy, including rules for entry, exit, and risk management. A trading plan is a roadmap that outlines how decisions are made, what criteria must be met before committing capital, and how much risk is acceptable in each position. While knowledge and strategy are essential, their value is compromised if a trader allows emotion to override them. Fear, for instance, may cause hesitation, leading to missed opportunities or premature exits from profitable trades. Greed, conversely, can push a trader to take on excessive risk, hold positions too long, or deviate from established rules in search of larger gains. The disciplined trader recognizes these tendencies and enforces strict adherence to the plan, understanding that consistent process yields far greater long-term results than sporadic success based on impulsive decisions. Emotional control is cultivated through self-awareness and repeated practice. A trader must develop the ability to observe thoughts and feelings as they arise, without allowing them to dictate immediate action. This involves creating a mental framework in which decisions are evaluated against objective criteria rather than subjective impulses. One method to reinforce this control is through structured routines, pre-trade analysis, checklist-based execution, journaling outcomes, and reviewing performance with a focus on process rather than result. Each of these routines acts as a buffer against reactive behavior, helping the trader respond calmly and rationally, even in situations of extreme market volatility or unexpected outcomes. Fear is one of the most potent forces in trading, often triggered by the possibility of loss, uncertainty, or deviation from expectations. Left unmanaged, fear can lead to hesitation, overtrading to make up for previous losses, or premature exits that undermine strategy. Successful traders recognize that fear is a natural response and use it as information rather than as a command to act. By following a plan, maintaining proper risk controls, and limiting position sizes, fear is transformed from a paralyzing influence into a guide that encourages caution, thorough analysis, and disciplined decision-making. Similarly, greed can erode discipline by encouraging overextension, impulsivity, and the abandonment of rules in pursuit of excessive reward. Emotional control requires acknowledging these tendencies and implementing safeguards such as predefined profit targets and strict adherence to position sizing that prevent greed from dominating behavior. The ability to adhere to a plan also strengthens confidence, but not the kind of confidence built on ego or assumptions of certainty. Confidence arises from repeated evidence of disciplined execution under varying conditions, where the trader consistently applies their strategy regardless of immediate outcome. Each trade executed according to plan, regardless of profit or loss, reinforces the trader's understanding of process over outcome. Over time, this evidence-based confidence reduces the influence of emotional volatility, allowing decisions to be guided by strategy rather than impulse. Adherence to the plan also entails patience. The disciplined trader understands that not every moment in the market offers an opportunity, and that waiting for the criteria defined by the plan is essential. Impatience often leads to entering trades prematurely, chasing setups, or deviating from rules in response to frustration. Emotional control strengthens patience by providing a mental buffer against these impulses. By maintaining focus on the process, the trader can resist the temptation to act on instinct alone, allowing the market to present high-probability opportunities that align with the strategy. Another dimension of emotional control involves managing responses to losses. Losing trades are inevitable, and how a trader responds to them is a reflection of discipline and emotional maturity. Emotional reactions to loss, such as frustration, self-doubt, or revenge trading, can cascade into additional mistakes and deviation from the plan. A trader with emotional control treats losses as information, analyzing them objectively to extract lessons while maintaining adherence to strategy. By separating the psychological impact of loss from decision-making, the trader maintains clarity, resilience, and the ability to execute the plan consistently. Emotional control also extends to the management of external distractions and internal narratives that can influence behavior. News, opinions, and market chatter may create fear or temptation to act outside of the plan. Internal narratives, self-talk, that reinforces doubt, overconfidence, or unrealistic expectations, can also interfere with discipline. By maintaining a structured approach, keeping routines, and adhering to defined rules, the trader creates a mental environment in which external noise and internal distortion are minimized. This clarity allows the trader to respond to market conditions objectively and consistently, relying on process rather than reaction. The development of emotional control is a continuous process. It requires regular self-assessment, reflection on behavior, and reinforcement of habits that support rational decision-making. Structured practices such as journaling, reviewing trades, and analyzing deviations from the plan provide insights into emotional triggers and behavioral tendencies. By systematically addressing these factors, the trader strengthens the ability to adhere to the plan even under stress, creating a feedback loop where disciplined behavior reinforces confidence and improves performance over time. In summary, emotional control and adherence to the plan are inseparable elements of successful trading. Emotional impulses are inevitable, but they do not have to dictate actions. through self-awareness, structured routines, disciplined execution, risk management, and continuous reflection, a trader can maintain composure in the face of uncertainty, resist the influence of fear and greed, and consistently apply a strategy that is aligned with long-term objectives. The consistent execution of a well-designed plan under varying market conditions reinforces confidence, cultivates patience, and strengthens resilience, providing the foundation for sustainable trading performance. Long-term success in trading is achieved through patience, self-awareness, and continuous improvement. Yet these qualities are often misunderstood or underestimated by traders who focus solely on short-term results. Patience is not simply the ability to wait, it is the conscious choice to adhere to a plan, to respect the natural rhythms of the market, and to allow strategies to work over time without being derailed by emotion or impulse. Traders who lack patience often force trades, chase patterns that do not meet their criteria, or abandon systems after a string of losses. In contrast, patient traders understand that the market is probabilistic and that outcomes should be evaluated over a series of trades rather than in isolation. Patience allows a trader to wait for high-quality opportunities, to follow a disciplined process, and to avoid actions driven by fear or greed, creating the conditions necessary for sustainable success. Self-awareness is equally essential. A trader who understands their own psychological tendencies, strengths, weaknesses, and emotional triggers is better equipped to navigate the inevitable challenges of the market. Self-awareness enables recognition of behaviors such as impulsive decision-making, overconfidence, hesitation, or the compulsion to recover losses immediately. By observing these patterns without judgment, the trader can implement corrective strategies, refine decision-making, and maintain adherence to the trading plan. Developing self-awareness is a continuous process requiring reflection, honest evaluation, and the ability to separate one's sense of self-worth from the outcome of individual trades. Without self-awareness, emotional reactions can dominate behavior, leading to inconsistent execution and undermining long-term objectives. Continuous improvement is the natural companion to patience and self-awareness. Markets are dynamic, and strategies that work in one environment may require adaptation in another. A trader committed to continuous improvement regularly evaluates performance, identifies areas for refinement, and seeks to expand knowledge and skill. This process includes analyzing trade outcomes, reviewing adherence to rules, and examining emotional responses to wins and losses. Continuous improvement is not a reactive process driven by immediate results. It is a deliberate and structured approach to learning and growth, emphasizing long-term development over short-term gratification. The integration of patience, self-awareness, and continuous improvement creates a feedback loop that strengthens performance over time. Patience allows the trader to execute the plan without being derailed by emotion. Self-awareness ensures that emotional and behavioral patterns are understood and managed effectively. Continuous improvement applies the lessons derived from experience to refine strategies and reinforce disciplined behavior. Together, these qualities foster resilience, adaptability, and consistent execution, which are essential for achieving sustained success in trading. Patience also involves understanding and accepting the probabilistic nature of the markets. No strategy can guarantee a profit on every trade, and losses are an inevitable part of the process. Traders who lack patience may abandon strategies prematurely after a string of losses or overtrade to compensate, undermining the probabilistic edge built into their approach. Those who cultivate patience recognize that individual trades are merely data points, and success is measured over time through consistent application of the strategy and proper risk management. Patience provides the mental space to evaluate trades objectively, resist the influence of short-term volatility, and maintain adherence to the plan, all of which contribute to long-term success. Self-awareness extends beyond recognizing emotional tendencies to include understanding cognitive biases, decision-making processes, and behavioral patterns that impact performance. Cognitive biases such as confirmation bias, overconfidence, or loss aversion can distort perception and lead to errors if unrecognized. A self-aware trader actively identifies these biases, examines their impact on decision-making, and implements strategies to mitigate their influence. This process strengthens discipline, improves clarity, and enhances the ability to execute the plan consistently, even under stress or uncertainty. Continuous improvement also requires a systematic approach. The trader establishes routines for reviewing trades, analyzing performance, and refining strategies based on observed outcomes. This process is iterative, with each cycle providing insights that inform adjustments to both technical methods and psychological approaches. For example, a trader may discover that certain setups are more effective under specific market conditions, or that emotional responses tend to escalate after a series of losses. By integrating these observations into practice, the trader gradually enhances performance, reduces errors, and increases the probability of consistent results over time. The combination of patience, self-awareness, and continuous improvement fosters emotional resilience. Trading is inherently stressful, and even the most well-designed strategies will encounter periods of drawdown. Resilience allows the trader to remain calm, adhere to the plan, and apply lessons learned rather than reacting impulsively or abandoning strategies in frustration. Emotional resilience also supports risk management, as the trader is less likely to increase position sizes or deviate from rules under pressure, ensuring the preservation of capital and the ability to participate in future opportunities. Patience, self-awareness, and continuous improvement also reinforce each other. Patience provides the mental stability required for self-reflection. Self-awareness illuminates areas where improvement is necessary. Continuous improvement strengthens confidence in one's abilities and the plan itself. This interdependence creates a self-reinforcing cycle in which disciplined behavior, emotional control, and strategic refinement feed into one another, producing incremental growth and cumulative progress. Over time, this approach allows the trader to develop mastery not only of technical strategies, but also of the psychological and behavioral dimensions of trading, which are often the decisive factors in long-term success. In practical terms, cultivating these qualities involves establishing clear routines and practices, maintaining a trade journal, reviewing performance systematically, and reflecting on emotional and behavioral patterns are critical. Setting realistic goals and benchmarks allows the trader to evaluate progress objectively and maintain motivation. Regularly revisiting and refining strategies ensures that the trader adapts to changing market conditions while reinforcing disciplined behavior. These practices support the development of patience, enhance self-awareness, and facilitate continuous improvement, forming the foundation for sustained success. Finally, understanding that trading is a journey rather than a destination encourages a mindset that values incremental progress and ongoing learning. The integration of patience, self-awareness, and continuous improvement enables the trader to navigate uncertainty, manage risk, and respond adaptively to challenges. By focusing on process, learning, and disciplined execution rather than immediate outcomes, the trader creates the conditions necessary for long-term performance and consistent achievement in the markets.